Hey everyone, Dalton Grados, Grados Capital here, coming to you with our weekly newsletter for this week. And again, make sure you are subscribed to that newsletter because I often do it in written form. You can find that at the first link of the description. And I'm trying to make these a little more in-depth now as I am evolving into portfolio manager, working on my CFA, all those kinds of things beyond just day trading, short-term time frame trading. Really want to make these just a little more comprehensive. So I'll be doing that. This video might be a little bit longer. You can of course watch it at 1.5 or even 2 times speed. But we're going to be talking about, kind of what to look for in the markets in general and more specifically for the week ahead. Of course, that all of these are just my opinions. I make no recommendations to buy or sell, just my opinions, and my opinions are solely my own and not those of any firm that I may be associated with. So honestly, just trying not to get in trouble, right? Just trying to do the right thing. This is just my commentary, my opinions, and that's it. So no harm there. Anyway, so let's just go ahead and start with what we got coming into this week with our economic events. So Monday, December 2nd, we have our manufacturing PMI. General rule with this is just above 50. It signals economic expansion, and below 50 would signal economic contraction. Obviously, we've been below 50 for a while, so economy's been contracting with higher interest rates. The idea being that with interest rates now easing, that we should get some expansion. Anything a tick up towards 50, closer to 50, would be generally good for the overall economy. But keep in mind, with a lot of this economic data, sometimes bad news is good news, right? Because that means that if the economy is worse than we think it is, or we hope it is, that the Fed will be forced to lower rates faster, right? They want to decrease those rates faster to make it easier on this struggling economy, to sort of stimulate the struggling economy. So again, you kind of got two time frames working here. In the long-term time frame, long-term investing, you generally want the economy to be good, right? So you'd like to see this tick up. But in the short time frame, you can also see bad news is good news because the Fed will be forced to act. So we got that manufacturing PMI coming in. And then we have the main other thing is just on Friday, non-farm payrolls, same kind of thing. Economic health, obviously, jobs being created is good. But again, same kind of thing. Bad news could be good news. So let's now look at the charts here. So I've got my main indices, the S&P, the NASDAQ, the Dow Jones, and the 10-year yield, which we'll talk about in a minute. So just looking at the charts here and really what's going on in the price action, obviously we're at our all-time highs. What stands out to me is that we have ES, the S&P, and the Dow here, industrials, really leading here, and the NASDAQ, which is tech heavy, lagging. So what that signals to me is we're having, even though we're at the highs and we've been rallying across the board, having a little bit of a shift in where investors are moving their money into. They're moving money more into industrials, right? And they're pulling money out of tech. So those growthier stocks, you think your Apple, Nvidia, Tesla, all those stocks, even Bitcoin, even though it's not in the S&P or NASDAQ, sort of that realm of things, the growthier positions, are lagging a little bit. And we're seeing, some of the more value positions, think companies like ExxonMobil and consumer staples and Boeing and things like that. Those value companies are starting to get more inflow. So interesting to note there. Going into this next week, if you're a short-term time frame trader, obviously we got to be cautious, right? So if you're a futures trader, it's like you're at the highs. So what can you say? I mean, okay, we could just keep kind of grinding higher, or we could pull back into some of these levels below us. If I'm looking at the S&P, maybe the 6,000 level would be a strong support. 5950 below that, 5900, and so on, and then above us 6100. I mean, that's pretty much what you can say when you're at the highs. Is you're just kind of cautiously, you don't want to jump in front of a train. It could still keep rallying, but you just kind of have to play it day by day. If I were a longer term investor, I would probably be selling put options on the market. So that's a good idea. You could collect some premium while you're waiting for the market to drop to lower prices, and so that way you're not buying at the all-time highs. If you are managing a large portfolio, maybe we're shifting more away from our growth positions that are lagging here. Maybe we're shifting a little bit away from those. Maybe we're shifting more into value when we're thinking about, managing an overall portfolio. Again, these are just ideas, just commentary. So, take that for what it's worth. Now, something that I want to discuss here that may be the focus of this week's newsletter, and maybe even be clipping this into another lesson, is the 10-year yield. All right. So let's kind of do a deep dive into the 10-year yield, what it means to us and what it means for the markets. So first off, what is the 10-year yield? So your government treasuries, U.S. government 10-year treasuries. So when you buy a 10-year bond, you are essentially lending money to the government. And if it's a 10-year bond, then they're gonna pay that back to you plus interest in a 10-year time frame, right? So it's the government's debt that they are paying back. This is a safe investment because it's backed by the government, so they'll always pay back their debt, right? Now, if you're thinking, well, I don't know, I understand there's a conversation there, but that's too far for this. For the purposes of talking about finance. The only time we can use the word guarantee in finance is when we're talking about government bonds. So we have to assume that the U.S. government is going to be good on their debt. So it's a safe investment. Now, a general way to think about the 10-year yield is, so the 10-year bond in particular, you have your short-term bonds, your 1 year, 2 year, and then you have your long-term, your 20-year, 30-year. With the 10-year kind of being in the middle, the 10-year is used really as a reference point across the board for things like our mortgage rates and things like that. It's really the staple that is looked at more than any other duration is the 10-year yield. So when we think about the yields and the prices of these bonds, they move inversely, right? So when we buy a bond, so there's two components of a bond. We'll just kind of get into like a lesson here on bonds, right? So two components of a bond. You have the price of the bond and you have the yield of the bond. So the price is like the actual price you pay for the bond, whether it's, par is like 100, right? So you say you pay $100 for a bond, or maybe if it's lower, if it's at a discount, you pay $94 for a bond, or and at a premium $105, so on. So that's the price you pay for the actual bond. The yield is the interest rate that bond is paying you. Okay, so again, two components: price and yield, and they move inversely to each other. So if I get out my little drawing here, right? So if you ever taken like a Series 7 or something like that, they always tell you, it's like a seesaw, right? So yields go up, prices go down, and of course, the inverse. If yields go down, then prices go up. Obviously, I'm drawing with my mouse here very fast, so this is not good artwork, but that's essentially the rule with bonds, right? So prices and yields move inverse to one another. Now, why is that? They tell you on a Series 7, use your pencil and and do the little trick there to remember that how they move. But why is that? Why do prices and yields move inverse to one another? Well, it's because the market is a market, right? There's your CFA level 2 lesson for the day. The market's a market. Who would have thought, right? So if I have, let me get rid of this here. So if I have, say I bought a bond and it's paying me 5%, right? That's horrible, but whatever. 5% bond. And and then I'm holding that bond. It's paying me 5%, and I'm gonna get 5% return on my money. But then interest rates go up, and so now if I were to buy a new bond, it's gonna pay me 7%, right? Well, let's say the price I bought this bond for, I bought it for $100. Okay. Well, now, how much? So when they issue this bond, the 7% bond, it's also going to be $100. So it's a market, right? Okay. If someone wants to buy my 5% bond, well, why would they pay $100 for it when you could pay $100 and get a 7%? Because interest rates are higher, right? So the price of my 5% bond now would have to go down, because you could pay $100 to get 7%. So clearly, if you're going to get a 5% bond, it's going to be cheaper, right? The value of it's gone down, right? So that's why bonds, prices, and yields move the way they do. So hopefully that makes sense. And hopefully you gained value. And maybe if I'm being a good YouTuber here, I would tell you that if you're enjoying this lesson, give a like on the video and subscribe to the channel. And I'll try to give more valuable content like this. So anyway, tying this back into the 10-year yield. Now that you know what you know about bonds and the yields of bonds and how they affect the prices, let's talk about how the 10-year yield is affecting the market and how we can sort of think about it. So we saw when the Fed began to cut interest rates, which is around this time frame, the 10-year yield went up. So that's kind of interesting. They're cutting rates. The interest rates are supposed to go lower, right? Well, then why would the interest rate for the 10-year bond go higher? I thought they were supposed to go lower if the Fed cut rates. Well, don't forget, it's a market, right? So think about this in terms of the flow of money, right? The flow of money. So people got excited when the Fed cut interest rates. So they sold their bonds. The money moved out of the bonds and into the stocks, right? Interest rates are lower. I'm excited about the future. I don't need safe investments anymore. I want to take risk because I'm excited. So that's what investors did. So this is the 10-year yield, right? If we go into ZN, that's the actual bond itself. The price of the bonds go down, right? If people are selling, let's get that stupid line out of the way. All right. So this is basically inverse to your 10-year yield. If I put this up here, 10-year yield. Okay. Right? So this is the price of the bonds. This is the yield of the bonds, right? So people are selling their bonds, right? So the prices are going down. There's sellers. When there's sellers in a market, prices go down. More people selling than buying. Prices go down, yields go up. Why are they selling bonds? Because they want to put it into the market to gain more return because they're optimistic about the market, right? So that's that flow of money at play, even though we had a Fed rate cut. Okay, so now we saw the 10-year yield go up because the safe investment, if people are going to move their money into riskier and riskier investments, the yields have to go up to attract buyers, right? So down here, nobody wants 3.8%, right? So these yields got to come up to attract people to buy, right? Oh, it's an auction. You want 3.8%, you want 3.9%, you want 4%, you want 4.1, 4.4 up here. Oh, okay. So now we're attracting some buyers. So I look down here again at my price. Now we're attracting some buyers. Okay, people like 4.4% for bonds. They're willing to forego taking on the risk of the riskier investment because now these bonds are paying what we'd like, right? So that's the flow of money. Hopefully all that is coming together and making sense. Yields have to go up to attract more investors. So now, what's interesting here, and what I want to point out, is these yields rose, right, to attract buyers into bonds because buyers were moving out of bonds and into stocks. Now they're starting to come down. The yields are starting to come down. And of course, we see that means, from what we learned earlier, the prices are starting to come up. So what does that mean? That means people are now moving money out of stocks and into bonds, right? And this is a daily chart. So this is over the past 1, 2, 3, 4, 5, call it days since the bottom here. So just in the past week or so, you're seeing a flow of money again into bonds because the prices are going up, the yields are coming down. We talked about how the markets were at highs, but our growth stocks, our NASDAQ, our tech stocks are lagging a little bit, and we're seeing the money shift from risk into safety. What does that mean for markets looking ahead? I'll let you be the judge of that. Start to think for yourself. Could that mean a potential pullback if the money is shifting towards safety? I don't know. So hopefully you enjoyed this video. Again, give a like, subscribe to the channel, and comment below what you found interesting or any questions I can answer. And share it with your friends, and I will see you guys next week. Again, don't forget to subscribe to the newsletter. It's totally free. I don't sell anything. But subscribe to the newsletter so that way you get it in your email inbox, whether it's a video like this or a written form on Substack. Make sure you're getting the newsletter. And again, I don't sell anything. Okay, it's Dalton Grados. I will see you guys next time.